Welcome to this tutorial on understanding candlesticks in crypto trading. Today, we'll be focusing on the two main types of candlesticks: continuation candlesticks and reversal candlesticks. Continuation candlesticks indicate strong movement in one direction. They have large bodies and small or non-existent wicks, showing that the market is decisively moving in that direction. This suggests strong buying pressure and indicates that the market is likely to continue moving upwards. And here is an example of a bearish continuation candlestick. Similarly, it has a large body with small or no wicks, indicating strong selling pressure and suggesting a continued downward movement. Reversal candlesticks, on the other hand, typically have long wicks. These wicks signify that the market is testing new levels but then reverses direction. Let's look at a bullish pin bar candle. Initially, bears push the price down, but then the bulls step in and push the price back up, resulting in a long lower wick. This often signals an area of interest where major market players like market makers, banks, or hedge funds are buying, indicating a potential upward reversal. Now, here's an example of a bearish pin bar candle. In this case, buyers push the price up initially, but then the bears take control and push it back down, resulting in a long upper wick. This typically signals a potential downward reversal, leading to a downtrend. Key takeaways to keep in mind: continuation candlesticks indicate strong directional movement with large bodies and small wicks. Reversal candlesticks indicate a potential reversal with long wicks, showing market testing and reversal actions. Understanding these candlesticks can give you valuable clues about the market's potential direction. Remember, candlesticks on higher time frames are even more powerful, offering a broader perspective of the market trends.